Hello, hello, hello. Hello, hello. Can you hear me? Can you hear me? Thank you, thank you. Welcome to the Max Options Trading Beginner Course. Day number 4. What you're going to need today is your pen and paper, an empty notebook, whether you're on your phone, laptop, PC, or tablet, and some room for push-ups. Today we're going to be covering the Greeks and implied volatility. This is a great class because a lot of you don't pay attention to this shit. And to be honest, you probably should. We had gone over the introduction. We know candlesticks now. We know how to use support and resistance in the multiple different ways. And today we're going to go over Greeks and IV, which is going to lead us right into Friday's class on choosing the contracts, expiration dates, strike prices, and learning the rest of the options contracts. All right, then we'll be headed off into a lovely weekend where I will be traveling the coast of Italy. Greeks and IV today, huh? Thank you for those who are a little bit early. I see you were discussing in the chat. That's fantastic. Find a nice quiet place today, free of distractions. Please be respectful at all times. Stay on mute. If you have any questions during any portion of this session at any time, please write it down and wait to the end of class. And I promise we'll get to those. Stay focused, stay on task. Some foul language may be used during this this beautiful class. This is an adult setting. So if you have any children nearby, I suggest you let them listen in and get them ready for the real world. Before we begin, make sure you guys are following us on social media. Follow us on Twitter at MaxOptionsTrade, Instagram at MaxOptionsTrading. If you tag our IG while you're taking the course, we'll give you a shout out right back. TikTok, MaxOptionsTrading with 2 Gs. And Reddit for your daily updates. Don't forget to click like and subscribe on the YouTube. Let me get a drink of water and then we shall begin. Hope you guys all had a good day today. Everyone have a good day? All right, let's get into it. The Greeks. Socrates, Socrates, and Tom Hanks. That's what we're going to be learning about today, ladies and gentlemen. We're going to be learning about the Greeks, Socrates, and Tom Hanks. This is my favorite joke, by the way. I'm like a terrible dad, all right? No, I mean these Greeks. We're going to talk about delta, gamma, and if you're only here to pay attention to one thing, pay attention to this right here, Theta. Vega and Rho. Did you hear my voice just now? Please, I mean, honestly, I sound like I should be at a strip club, right? Introducing Cinnamon to the main stage. Let's be honest here. I got the face for radio, huh? All right, let's talk about Delta. Enough horsing around. This is the measure of change in an options price or premium resulting from a change in the underlying asset, all right? So a high delta's options premium will increase more than a low delta's option premium for every $1 the stock gains. A high delta options premium will also fall more than a low delta options premium for every $1 the stock loses, all right? So for example, if the delta is 0.06, then for every $1 the stock rises, the premium will rise 60 cents. Now we're options traders, so that 60 cents is times the 100. So that means you're really gonna go up $60 per options contract for every dollar that underlying moves, all right? Delta also has a secondary reason that a lot of people don't know about. For example, an out-of-the-money call option with a delta of 0.2 has roughly a 20% chance of being in the money at that expiration date. So delta not only tells you the change of price per dollar, it also tells you the percentage that you're going to wind up in the money. All right. So delta has 2 huge things that it's telling you on these options contracts. So a delta, a deep in the money call option with a 0.95 delta has roughly a 95% chance of being in the money at expiration. And it also goes up $95 per $1 that the stock goes up. All right. Delta is also used to determine directional risk. Positive deltas are long market assumptions and negative deltas are short market assumptions. Neutral deltas are neutral market assumptions. The three main things to keep in mind when considering delta: it tends to increase as expirations approach for near at the money options. Delta is further evaluated by gamma, which measures the delta's rate of change. Delta can also change in reaction to implied volatility. All right, so let's take a look at an options contract. For this example, I'm going to be using my big, deep, stretched out Robinhood. All right, you can see that these are earlier in February. This is Tesla. If you look at the top, you'll see these are Tesla contracts. And the current underlying price of Tesla was $810.36. So on the left, we could see that we have a 219 contract here, expiration of February 19th. And we come on down here, and we see that we have a delta of 0.4875. This means for every dollar that Tesla goes up, so if it goes from 810 to 811, that means this options bid premium right here, the options premium, will go up $48. All right. This also means that by February 19th, the expiration date, Tesla has a 48% chance of going in the money, which is another $5 above the current price, has a 48% chance of going in the money by that expiration date. And you can see the difference here, which is just a little bit on Tesla. If we add 2 weeks of expiration and leave the same strike price, you'll see the delta has increased to 51. So that means every time that Tesla goes up $1, this stock goes up $51, this options contract. And it also means that there's a 51% chance that Tesla will go in the money by 3/5. Pretty cool, right? That's delta. So delta is one of the good ones you want to take a look at real quick when you're checking out options contracts. So let's talk about gamma. This measures delta's rate of change over time, as well as the rate of change in the stock itself. All right. So gamma is used to help forecast price moves in the stock. Since delta's values are constantly changing with the stock's price, gamma is used to measure the rate of change and provide traders with an idea of what to expect in the near future. So since gamma is a constant that represents the rate of change in delta, it is useful for determining stability of delta, which can be used to determine the likelihood of an option reaching the strike price at expiration. All right, so this is a much easier way to think of it. A good way to think of gamma is the measure of stability of an option's probability. All right, what are the chances that that option is going to be stable enough to go in the money? All right, if delta represents the probability of being in the money at expiration, gamma represents the stability of that happening. Gamma values are highest for at the money options and lowest for deep in the money or out of the money options. For example, suppose that two options have the same delta value, but one option has a high gamma and one has a low gamma. The option with the higher gamma will have a higher risk, since an unfavorable move in the underlying asset will have an oversized impact, because the higher the gamma, the more volatility and the more unstable the delta is. The lower the gamma, the more stable the delta is, the less volatility. So an option with a gamma of and a 7.5 delta, high gamma and high delta, may have a less chance of expiring in the money than a low gamma option with the same delta. All right, so you want something that has high delta, lower gamma, because gamma, lower the gamma, it's going to show you the more stability that that option has of reaching in the money. Gamma is the smallest for deep out of the money contracts, and it's the highest when options get near the money. So let's take a look at the gamma. So we can see here on the 219 expiration on the left of Tesla, right? The gamma is at a 0.0062. So we got a 0.62 gamma. So that means there's like a 62 reading on this, that this is not very stable. This delta is not very stable. So this delta could change rapidly based on if it's going to reach the strike price of 815 or not. So if we're going to go plus $5 by that expiration date. But if you look, the further we go out of the money, like we just talked about, now we're down to a 0.0034, a lower gamma with a higher delta. This is what you want. You want a lower gamma with a higher delta. So if it requires you possibly swing trading a week out, then I would suggest doing it, because what this is saying is that this contract here has double the chance of delta going in the money just because you added those 2 weeks. And that's what we're looking for. What is the chance, the stability that this probably goes in the money? That's exactly what gamma does. Make sense? Let's talk about theta, theta, theta. All right, wake up, everybody. Everyone get your pen and papers out. I put this whole fucking page in green so it sticks out like a sore thumb for you guys, all right? If you weren't paying attention before, I highly suggest you pay attention right now. Theta measures the rate of time decay. That word, 2 words we hear all the time right here. I'm getting killed by time decay. You're getting killed by theta. This is the value of option or its premium. Time decay is the erosion of an option's value from the passage of time. As time passes, the chance of the option being profitable or in the money lessens. Time decay tends to accelerate as the expiration date of an option draws closer, because the less time you have, the less time you have the profit. Theta is always negative for a single option. Remember that. Theta is always negative for a single option since time moves in one direction. Unfortunately, we haven't figured out how to turn that bitch back yet. Theta is great for sellers like Max. Max sells premium. This is how I make 6 figures a year. I do nothing but sell the shit out of premium. I make $2 grand a week selling deep out of the money premiums. It's what I do. Theta is my best friend. Essentially, Theta employs me to live a great life. So for example, assume an investor is long with an option of a theta of negative 0.50. The option's price would decrease by 50 cents a day. All right, times that by 100, because we're options traders, so that is decreasing $50 a day. That passes. All being equal, there are 3 additional things to keep in mind when considering theta. All right, the 3 things you want to consider are that it could be really high for out of the money options since they carry a lot of implied volatility. Don't worry, we're going to break that down for you here soon. Theta will increase sharply as time decay accelerates in the last few weeks. So if you're about 10 weeks out, when you start closing in on those 1-2 weeks of expiration, theta is going to start spiking dramatically. All right, and the last thing to remember is that it could severely undermine a long options position. It could really hurt you and start cutting your pricing down. I have been crucially destroyed by theta before. It is a mistake I've made once, and I've never made it again because it cost me $31,000. So let's take a look at Tesla's contracts again. So now we know that this contract's going to go up $48 for every $1 the underlying asset raises. We also know that it has a 48% chance of going in the money on that expiration date. And we also know by the gamma here that it's pretty volatile, but we're looking at about a 62% chance that it doesn't go. All right, now let's take a look at the theta here. We have minus 161. Now that means every day that passes, we're going to subtract $161 off this bid. So this 23.45, no matter what happens tomorrow, is automatically 21.79. All right. Don't check that math because I literally just shit it out of my head. Don't check that math, but I think it's right. Might not be. And so that's how it works. So that's how it is. So on this one, just to recap, delta, $51 every time the stock goes up $1, $51 up or down, 51% chance. Theta on this one, since we have that extra 2 weeks, is only $1.06. So that means every day that passes, we lose $106 off this options contract. So when we wake up tomorrow, how many people here have traded options and Tesla opens up flat tomorrow, maybe even $1 or $2 green, but you look and your 44.20 contract opens up at 41.10 and you're like, what the hell just happened? Well, I can tell you, you lost 106 from time decay automatically. The rest may have came from this bad boy right here, which we're going to talk about in a second. So that's how theta works. Some things to know about theta that I don't know if I said here. Oh, it's probably at the end I'm going to go over it. Some of the myths about Theta is that it's happening every 5 seconds. It's not the case. Theta does not include weekends and holidays. Theta is priced in for daily action split over a trading day's time from 9:30 a.m. Eastern to 4 p.m. Eastern. All right. So for all of you guys that are like, oh, I'm not swinging this shit, I don't want to get killed on the weekend for Theta. You're killing me when you say things like that. That's what's actually happening. So let's talk about Vega. Vega is the expected volatility of underlying assets price. Vega represents the amount that an options contract's price changes in reaction to a 1% change in the IV of that underlying asset. So while Delta measures the actual price change, Vega's focus is on the expectations of future volatility. All right. So when I say that, some of the things, I'm going to actually hold off. Some of the things that could cause that, I'll explain in a second. Higher volatility makes options more expensive since there's a greater likelihood of hitting that strike price at some point because of volatility. Vega tells us approximately how much an option will decrease or increase in the level of implied volatility. Option sellers like Max benefit from falls in IV because IV crushes contracts when it drops dramatically. But options buyers, if you're in naked calls or puts, benefit from a spike in IV because it creates premium spikes. Option traders, that's why if you've ever been in a contract and some news breaks about an option, but it hasn't broken completely, they just have like a meeting coming out or an earnings report, you'll notice that a spike in IV can cause your premiums to go through the roof. All right. Long options traders benefit from pricing being bid up, and options traders benefit from prices being digged down. This is why long options have positive Vega and short options have a negative Vega. For example, if the Vega is a quarter, 0.25, and the IV increases by 1%, then the options bid-ask price should increase by 0.25. We take that 0.25, we multiply it by 100 because we're options traders, and you get $25 that options premium will increase. If the Vega of an option is greater than the bid-ask spread, then the option is said to offer a competitive spread. All right. Remember, you're supposed to check those bid asks. That's something that we're going to go over tomorrow in tomorrow's class, but that Vega has an impact on that. This is just one thing to consider, as too high of a spread could make getting in and out of trades extremely difficult. If you've ever tried to close an iron condor in a flat market, holy shit, you can find out how difficult it really is. But there's 3 additional things to try and keep in mind when considering Vega. Vega can increase or decrease without price changes of the underlying asset. Remember that. The stock can stay completely flat, but the Vega can spike and drop dramatically based on news, based on sentiment, based on maybe something that happened in the sector due to the changes in IV. Vega can increase in reaction to do quick moves in the underlying asset, and the Vega falls as the option gets closer to the expiration. So we're back to our Tesla contracts. Let's recap again for everybody. We're going to keep recapping till this is absolutely buried in your heads. Delta is giving us 2 things: a $48 increase or decrease every time the underlying asset moves $1. It's also saying that I have a 48% chance of going in the money by that expiration date. All right. This gamma is measuring the stability of the probability that this happens. Okay. Theta is telling me that every day I wake up in the morning, I'm losing $161 because of time decay. Time decay does not include weekends and holidays. It happens every day, stretched out over a trading day period. Now, Vega is telling me that the IV on this contract is 53.81%, but the Vega on this contract is 47. So if this IV were to jump to 54.81, that means I would gain $47 back on my options premium right there, taking away from those time decay losses. So all you need is Tesla to go up about $2.50, and the Vega, the IV, to go up 1%, and that would completely negate your time decay. Pretty neat, right? So now we see delta, how gamma plays into it, what theta does up here, strict time decay, and how Vega is brought in by changing the rate of change based on the implied volatility. And that's exactly how Vega works. If we took a look over here, you would see that the IV is 58% and the Vega is 79. So that means every 1% this goes up or down, this underlying would either be plus or plus $79 per options contract. Pretty cool, huh? Pretty nice when you start putting all these little bad mamma jammas together, the little fucking Greek tea party down here, right? Pretty cool. Row, row, row your boat gently down. Do push-ups. All right. Grow up. If you're too immature to take this class serious and you started singing that song with me, do push-ups. All right. You need to be mature enough to glance at the Greeks before you YOLO half your fucking accounts into some options contracts that you have know nothing about the underlying asset at all. You're just doing it because you heard about it on TikTok from some 18-year-old. All right. So have some maturity when you're talking about the Greeks. Everyone do push-ups. Rho measures the change in option premiums due to interest rates, federal interest rates. All right. So example, if Rho is a quarter and the interest rates are increased by $1, the price of the contracts would increase by $25 because we're options traders. Everything's times the 100. All right. If the interest rates decrease by 1%, then the price of the options would decrease by $25. Rho is usually considered to be the least important of all options Greeks, like a redheaded stepchild. Yeah, I wrote that because nobody gives a fuck about Rho. Rho does nothing. Rho gets constant disrespect. All right. I'm going to show you guys why. Because we do all these great things right here. All right, let's go over this again quickly. We have delta, which is giving us a $48 increase, whether or decrease if the stock goes up or down. And it also means that I have a 48% chance of this contract going in the money. Gamma is measuring the stability of the probability that this 48 happens. All right, theta is sitting here eating away $161 of my shit every day I wake up. And Vega is saying, well, it's at 53% IV, but if it goes up or down to 54 or 52, we'll add or minus plus or minus $47 to your options premiums. All right. Row your boat is at 0.0814. This means that if interest rates, the federal government decides to hike up interest rates, you'll get $8 on your premium. So you can see here why nobody gives a shit about Rho. All right. Rho is not going to change very frequently. Rho is not very important. And that's really it. That's all I'm going to talk about Rho, because I'm honestly, I don't want to talk about it anymore. It's disgusting. We're going to talk about implied volatility next. Let me get a sip of water real quick. Too much hot voice going on. A little bit of bubble water in my life, ladies and gentlemen. I swear I'm going to start a brand called Bubble Water. If you guys don't drink Frizzante Blue, then maybe you're not on the coast of Italy right now. You heard that, Nikki? You heard that, Nikki? All right, so what the hell is implied volatility? Let's talk about IV. I'm going to call it IV for you guys, implied volatility. First off, let's start by calling it IV. Okay, I've been doing this too many times. This is what I'm going to need after this class makes me drink this weekend. You guys make me want to drink. So that's what I'm going to need, a nice IV. IV is a metric that captures the market's view of the likelihood of changes in a given security's price. Investors can use it to project future moves and supply and demand. Often employ it to the price of options contracts. All right, let's talk about IV some more. Here's the 3 big impacts on IV. Now, remember, like this whole class, I didn't write any of this shit. I just found it from multiple sources and I'm breaking it down for you guys. So, but this is something you need to write down, because IV has 3 different major impacts. All right, it impacts premiums majorly. Volatility represents the anticipated volatility of a stock over the life of your options contract. As the expectations change, so do the options premiums. All right, in order to make a successful premium trade, buy an option with low IV and sell the option when the IV spikes. So we do this on methods like the ER run-up. If you have an earnings report 3 weeks from now in your favorite stock, right, you can buy an out-of-the-money call option. If you're very bullish on it, you can buy a very out-of-the-money call option. And as the stock comes cruising into earnings report, you'll notice the IV spike as it gets closer will cause your out-of-the-money call options to normally be profitable. So the ER run-up, this is exactly what you're doing. And then you have the people that play the ER, and you'll see that the ER was flat. So that 200% IV contract that you were just in tanks back down to 50. Now we were just doing the math on the Tesla, right? So if this IV was 250 or 200 and it drops 150 points, that's 150 times $47 that you're going to tank right there. And that's why contracts go down 90% after earnings reports. That's why. That's an IV crush right there for you, is a absolute tank of implied volatility. The second thing that IV really impacts is option durations. All right, different types of options result in different reactions to IV. So the shorter weekly and scalp expiration date options will be less sensitive to IV. It's the long dated swing trade options and the leap trades that are most sensitive to it. This is because long out swing trades have more time value priced into them, whereas short dated options have less. So the less volume, the less volatility impacts that contract. The more time you have, the more you're going to have. In order to make a successful premium trade for a short dated option, buy an option with a higher intrinsic value because time value is less priced in. All right, when we're talking intrinsic value, so if you buy the $50 strike price and the current stock price is at $53, that means you are purchasing $3 of intrinsic value. That's the difference between your strike and the underlyings in the money underlying value. Does that make sense? So intrinsic value is that difference there. In order to make a successful premium trade on a long dated option, buy an option with a low IV because the time value is more priced in. You're going to learn about this more when I teach you how I swing trade and how I do this. I buy options with lower IV because I'm trading time value for implied volatility. And this is why I have a high success rate in my swing trades. I'm going to show you this next Tuesday, I believe. When IV begins to increase, the higher sensitivity will result in a much larger, much more dramatic premium increase for those that are in the trade. The last thing IV impacts is your strike price. All right. Each strike price responds differently to the change in IV in reference to near the money options are the most sensitive to changes in IV, while options that are further OTM or further ITM in the money are less sensitive to these volatility changes. That's usually because they're already very, very high or very, very low, where near the money is kind of not really figured out where to go yet. Does that make sense? He's kind of figured out, hey, I'm done with this swing. I'm good. Whereas out of the money and in the money is still trying to, they're sitting at the ceiling and the floor. So there's a lot of room to go. Let's talk about IV some more. When applied to the stock market, implied volatility generally increases in bear markets. That's why when you see these red days, these huge puts make big money. The reason puts usually make quicker and better money than calls is because there's also an IV spike in the market. And this causes the delta. This causes, all of the other thing with the delta. This causes other options premiums to rise significantly. And so in bear markets, when investors believe equity prices will decline over time, IV will increase significantly. IV decreases when the market's bullish. When we have a steady uptrend, IV tends to go down. Now, a lot of people are worried they're making money. There's nothing to really fear. Bearish markets are going to be considered to be undesirable, hence riskier. And the more risk, the more IV we have. Implied volatility does not predict the direction in which the price will proceed. Remember that the higher the IV doesn't mean that it's going to go up. It doesn't mean it's going to go down. It's just telling you that it's probably going to be a big move up or down. So a large price swing is probably going to happen, but it could swing upward very high, could swing downward very low, or fluctuate between the two. And when that happens, that's where you get another IV crush if it fluctuates like that. You could use the VIX to help measure IV. VIX, VIX. If you're a Robinhood trader, it's VXX. If you're a Robinhood gambler, you could use UVXY as a 3-time leveraged VIX, which is extremely volatile. But the VIX is a real-time market index that uses price data from near-dated, near-the-money SP 500 index options to project expectations of implied volatility over the next 30 days. So when the VIX is spiking, a lot of people think, oh, SPY's dumping, the VIX is going, or the VIX is going, SPY's going to dump. That's not necessarily true because remember, spikes in IV don't tell you which direction that the market's going to go. So a lot of people think, oh, because the VIX is rising, the market's going to tank. That's not necessarily true. It's just letting you know that we're getting ready for larger price movements. It could be to the upside. It could be to the downside. But it is important to follow your VIX and just see what the SP 500 index is looking like, the volatility for the next 30 days. And that's what it does. It's the measurement. It's also known as the fear indicator or the fear factor of the market. Pretty cool shit, right? Bet you guys didn't know that. You're welcome. I take tips. Let's head on back to our contract. So here is the implied volatility at 53.81%. You can see the IV is higher on the longer out contract because that's what we talked about. The IV gets higher the further out you are because you're trading IV for time value. The higher IV, the more time value because you have there's a greater chance of things happening. So this is the IV on your contracts right here. We also know that the IV impacts the Vega. Remember, if the IV goes up or down 1%, then the Vega is going to change the options premium by the underlying right here, 47 or 79 bucks per 1%. And this is where you'll find IV. Every contract has this IV. Robinhood has their own chance of profit indicator here, but it's just their own algorithmic bullshit. But the IV, the chance of profit, and now all the Greeks. So you guys should know how to read the entire bottom of an options contract now completely to its entirety and understand how the Greeks and IV impact this price right here. So when you're not sure of why your contracts aren't going up or why your contracts are going down, take a look at your option. Open this up, take a look at the Greeks. Now that you know how to read it appropriately, you could say, oh shit, when I bought it, the IV was at 65, now it's at 53. That's why I'm losing money. It's not because of the delta or the theta, it's probably because of the IV. So let's understand how we get that percentage. How do we get 53 and 58? That's always a good question. Like, what the hell does this even mean? All right. What this represents is an annual 1 standard deviation range for the stock based on the options price. All right. That may sound confusing, but let me give you an example of this. The IV on Tesla at 54%. Let me clean this shit off for you guys real quick. So let's just say this is 54%. Let's just round up and make this 54%, okay? This means that the stock price is at $810. This means that 1 standard deviation range of $437 over the next year. So if you recall from your fancy college classes, I'm a high school dropout. I just learned this shit. But if you recall from your stat classes, you'll know that the 1 standard deviation represents about 68% of outcomes, which is also the most respected Fibonacci level. Remember, I told you it pops up all the time in random shit. Pretty cool, huh? So when it comes to IV, this just means that there's an approximate 68% chance that Tesla's stock, currently priced at $810, will sell between $373 and $1247 1 year from now. So IV does not, once again, it does not help you determine direction. All right. Now I know it's a little confusing, so let me draw it out for you. All right, let's draw a cone here. The current stock price is $810 on Tesla. There's a 68% chance, according to one standard deviation, that it's going to go to 373 in 1 year or 1247 in 1 year. And that's what that means. That's how we're finding what this means is that according to one standard deviation, a year from now, there's a 54% chance that this stock's going to be 1247 to 373, in between 373 and 1247. And that's the math behind implied volatility right there. Well, if you weren't paying attention, now you're probably confused as shit. It simply measures a stock's uncertainty at the end of the day. So when a stock is more uncertain, when it be from earnings reports, breaking news, CEOs quitting or new CEOs being replaced, massive sell-offs, there's a demand for insurance, which is what options contracts are. So the options rate should go up as the volatility does. Does that make sense? Let's conclude this bad boy. The Greeks help provide important measurements of an option's position's risks and potential rewards. So once you have a clear understanding of the basics, you can begin to apply this to your current strategies. It's not enough to just know the capital at risk. A lot of people just say, oh, well, I'm going to lose 1,000 on this one. It's not enough. You need to understand the probability of that trade making money, and it's essential to be able to determine a variety of the risk that you're exposed to. So you need to know the Greeks in an IV. Since the market is consistently changing, the Greeks provide traders with a means of determining how sensitive your trade is to price fluctuations, volatility fluctuations, and your price value, your time value. Combining an understanding of the Greeks with the powerful insights the risk graph provide can take your options trading to the next level. Just knowing something like this will definitely take your options to the next level. Implied volatility is the market's forecast of a likely movement in a security's price, whether it be up or down. Remember, it doesn't tell you which direction. It simply is often used to price options contracts. High implied volatility results in options with higher premiums and vice versa. Supply and demand and time value are major determining factors calculating that IV. IV is usually increasing in bearish markets and decreasing in bullish markets. There's your recap. The Greeks and IV. Thank you guys so much. Now that you're familiar with them and you're like, holy shit, I actually understand that. I know what the Greeks are and implied volatility. Does anyone have any questions at this time? Thank you guys so much for attending day 4 of the Max Options Trading Beginner course. We will see you tomorrow. Does anyone have any questions at all? Thank you guys for attending. We'd love a review. Please let me know if I'm an idiot or if you really enjoyed that. I'd love an honest review. Let's hit the chat. If you guys have any questions at this time, please let me know. What the hell just happened? Yes, Ben, this will be recorded and reposted for you, my friend. Absolutely. I think my screen is having a seizure. Your broker, TD Ameritrade, does show the Greeks. Do not be confused. It is on every single option, my friend. No, I'm not going to cover the entire Delta again. You could watch the rerun, my friend. Unfortunately, you were a little late to class. Ben, it will be posted. I think my Microsoft just took a shit. Looks like it did. Does anyone have any questions at all regarding the Greeks or implied volatility? Does open interest matter? We're going to learn about that OI. We're going to learn about that when we talk about choosing the right contracts tomorrow. We're going to learn about open interest and volume. So stay around, brother. We're going to go over it all tomorrow. So if the contract is at 810, you need to hit 815 by 219 to make money, or can you make money even if it doesn't hit that price? Yeah, with options, it doesn't have to hit your strike price. Your strike price can still be out of the money and you can still secure profits. Your options profits increase significantly when you go in the money and that intrinsic value rises. That's when you start compounding massive gains. The biggest options gains you can get, profits come from out of the money contracts that go in the money, because of the other things I just described to you, Helios. So you don't need strike price to strike price doesn't mean shit. It's about the delta. Does the IV increase? How much theta do we got? Is the gamma low? Is the Vega giving me a good return on that spike of IV? You see what I'm saying? So if you went all in on a call on Neo, will you be broke the next day? I hope so, Stephen, because of your poor risk management. I hope you go broke. I'm just kidding. I hope you make $1 million, but that would be very unwise of you, my friend. Does anybody at all have any questions? Going once, last questions, my friends. So you want it to hit 815, but if it hits 812 with the right Greeks, you'll make money. That is correct. Absolutely. Any last questions before we call it a lovely, lovely night? I'm actually I'm about 2 hours from Rome right now. Salag. So maybe I'll go over there. What's the most hurtful thing to holding options? Your heart is probably going to be hurt the most if you hold options, my friend. In the long run, Theta will decrease an options premium. If that's what you're trying to ask, Koji, Theta will decrease an options premium. Definitely worse than anything, because it starts immediately. The second you purchase that contract, you're losing money. Think of Theta like driving a car off the fucking lot, brand new. The second you start driving that car off the lot, it is depreciated significantly. So, all right, everybody. Thank you guys so much for coming out. Really appreciate it. I love teaching this class, and we'll see you guys at the buzzer tomorrow. Happy Friday tomorrow. And we'll finish up the week in this class super strong. If you guys have any reviews you'd like to put out, please do. And if not, you guys have a great, great, great evening. Take care.